So you're looking for rate cuts? That's one of the great conversations in the market right now. What the market thinks, what the Fed says, you're going with the market.
I think there's two reasons why the Fed might have to cut by the end of the year. The first we've been thinking about for a while, potential recession into year end. If we see that inflation is closer to 3%, even 3.5%, if economic growth is actually potentially negative or slow, it's going to be hard for the Fed to keep rates above 5%. And then as we think about some of these ongoing banking issues, obviously, of course, that is leading to slowing credit growth. We saw that in the senior loan officer survey this afternoon. But in addition, not only will it tend to slow down economic growth from that perspective, but also it's putting a lot of pressure, higher rates, on the banking system in general. And when we think about what is the solution to relieve some of that pressure from small and medium-sized banks, that has to do squarely with rates. There's a number of other band-aids that we could apply from a policy perspective, but the big one is bringing rates down to a more reasonable level so that it's not putting as much pressure on deposit bases.
Marko Kolanovic, also of JPMorgan, essentially says today, be careful what you wish for if you're looking for, as the market is, rate cuts, because that means that the economy has gotten to a point where they have to cut rates, and that's not good for risk. Is that sort of, would you share those views?
I would share those views because essentially it's not that the Fed would be cutting preemptively. They have said long since the cycle has begun that they want to get rates to a restrictive level and hold. So they absolutely don't want to cut. So if they did cut, it would probably be because they're essentially forced to cut based on financial or economic data. So in that case, it would not necessarily be a positive for risk assets.
Where are you right now on your view of where do you think we're going from here? I mean, the market's been resilient, maybe more so than people thought. We got right on the doorstep of 4,200, and then we faltered back, looked like we were going to break down. We were teetering a little bit, and here we are back, as of the end of last week, moving back higher. How does it look?
It's possible that we stay a bit range-bound for the near term as the market and the economy continues to absorb rates at over 5% and some of the other risks that we have on the table. But if we see further deterioration from where we are today, that could result in a bit of more of a downward trend. So I know you're having a prior discussion about 4,400 versus 3,800. Yeah. I'd say that 3,800 is probably more likely than 4,400, especially when you fold in the profits picture. Profits for a year now have been better than expected, but nonetheless, I don't think there's a catalyst to catapult them higher. So when we think about valuations, when we think about profits, when we think about weakening economic growth, I think we could see the market slide a bit more from here. Doesn't mean we have to reestablish a new market low, but we have a lot of headwinds ahead of us that could cause a bit more gyrations.
You like international over U.S.? Correct?
We've had a pretty unwavering commitment to international this year, and it's been, pretty fruitful so far because we've seen that the dollar has continued to slowly but surely move lower. When we think about recession risks outside of the U.S., from a European perspective, looks like they'll be able to avoid recession for longer than the U.S. China is picking up. It was that the ceiling on Chinese growth was 5%. Now it's looking like the floor. So as we see different markets pick up, that could lead to better earnings outcomes and potential earnings upgrades. Add valuations into the mix. There's just still a lot of reasons to like international over what we're seeing in the U.S.